From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, October 8th. You're listening to the Macrocast. This is Tony Fratto with Hamilton Place Strategies. Brendan Walsh and John Fagan here from Markets Policy Partners. And as he is on every jobs day, the great Matt McDonald. Matt, we had a fun number, surprised everybody in a lot of different ways and a lot of chew on. You want to run through the numbers?
I will. I don't know if fun is the right word for it.
Always fun.
But I'll go through it. The non-farm payroll number in September was 194,000. I think that's seen as a pretty significant miss. Of note, the unemployment rate dropped a lot. It came down from 5.2 to 4.8%. Some of the numbers under the hood on this, just from the top line from the employment survey, you saw leisure and hospitality up by 74,000, which is, okay, probably not in the range of what we'd like to see in that space. Of note, employment was down by 144,000 in local government education. So there's definitely a lot of messiness in some of the school numbers and seasonality here that may smooth out over time. The other thing that, just anytime you see the unemployment rate drop by that much, we're kind of regardless of the top line number, it's worth looking at the household survey. On that side, you had a decrease in the unemployed number of 710,000. And the composition of that was close to a drop of 200,000 in the labor force, and then an increase in the employment side of a little over 500,000. So when you get into the mechanics on some of this stuff, there's just a lot of messiness to the report. I think on a basic level, the top line number is just not what we need, but it kind of, my takeaway on this whole exercise is that the job supply chain is just as messy as every other supply chain right now. There's just a lot of messiness to kind of hash out, and kind of unclear where this goes or how people will read it. I think, I don't think this is the kind of number that anyone wants to see at this point. We've still got, there's still a lot of kind of shoes to drop in the job market, including kind of the tail end of unemployment assistance and then Delta and where Delta is and that sort of stuff. But, but this isn't exactly a springboard number to launch into economic growth with.
I agree. And there was seasonal adjustment issues, but when you just take a step back, September, August were weaker than June and July. So Delta is clearly playing a role in our economy. And one thing I don't know I worry about, but it's kind of becoming clear. I think a lot of baby boomers are just saying, I'm retired. I'm not coming back. And that's a large number to take out of the workforce.
Those household numbers, though, which were, did show a decrease unemployed, increase in employed. The 4.8 unemployment rate, whatever the factors are, doesn't seem to be necessarily participation. At some point, I want us to get into talking about how much of this is structural. Right. Versus not exactly, not cyclical, but unique idiosyncratic factors, not just with the return of COVID with Delta, but also everybody pointed to September, and I think we all pointed to September as an important month because of unemployment benefits running out, but also, as Matt pointed out, there's just a lot of noise there with, but not just the fact that you have back to school under unusual circumstances, but how BLS models that. Because remember that these aren't actual counts; these are estimates relative to BLS modeling, and so it's hard to get those things right. I also think, though, that there's just the noise from UI running out. People have great. Normally we see UI benefits running out and people rushing into the workforce. But if you've got really healthy balance sheets, you may still be picky, even if you're boosted unemployment benefits. You still have, if you're still good on, you're paying your rent or your mortgage and your utilities, you still might not take the first job available. You may still want to be a little bit picky. I actually think just October, for all of these reasons, is going to be a much more, we'll draw a much more accurate picture to what we're seeing. I don't know if the numbers will be better or worse or whatever. I just think October is a better month to look at than September.
Yeah, there's a couple of things to think about looking around the corner. I mean, relevant to the participation, one piece that BLS highlighted is that the employment population ratio right now is at 58.7%. So setting aside kind of workforce participation, that sort of stuff, that is below, it was at 61.1 in February 2020. Yeah. During the last recovery, there was a lot of, and it was slower and it was longer, but there was a lot of tracking of if you control for aging and population changes and that sort of stuff, what are you really looking at here? This recovery hasn't been long enough for that drop between February 2020 and now to ascribe to fundamental changes in aging and that sort of stuff. It's people, based on what they've experienced over the past year, people may be making different choices about what they want to do or not do, but you haven't had that long for that to take an impact. And then, Tony, I think you're right. October will probably be a better read. November and December could be real messy, though. Typically you have a lot of seasonality in terms of hiring for the holidays. And I'm ready to go toy shopping now because I think it's going to be a disaster.
we're not going to
disaster meaning that there won't be toys in November, December. Yeah.
It would be a personal disaster in my home. Yes.
Yeah. There's the port of LA is backed up massively, and that's sitting with toys on those boats.
Right. So do retailers hire up if
it's a good point.
There's no supply, or if people are shopping online months ahead or whatever happens? I don't know. I think we will get a better read in October for the reasons that you outlined, Tony, but I'm not convinced that the end of the year might not be just more of the same kind of train wreck messiness in jobs numbers of there's an exception to every data point, and how do you read it? Which, if you're in charge of the economy, feels like it would be a complicating factor to big decisions that you're trying to make.
And also a lot of those seasonally. Yeah.
It's such an important point because of what I was saying earlier, like the household survey is a count, but the payrolls survey is a modeled estimate.
Yeah.
And to your point, Matt, we have nothing to model against. I have no idea. It's a bewildering challenge for BLS to estimate what they think, the seasonality effects ought to be in November and December, so that they can then take the survey and compare it to what that estimate is. I don't know how they do that, and they're the best in the world at doing it, but it's a huge challenge. And so I just think it's there is going to be a lot of noise on this stuff. So
one of the challenging aspects it really has been the fact that the Fed, this was obviously going to be a really big non-farm payrolls number anyway, just for the information content and everything that you just said about the cross currents in September. But the Fed essentially focused everybody in the market's attention on this number as the potential pivoting factor for when they were going to announce the taper of quantitative easing, the asset purchase program, or QE, more colloquially known as. And this, in some sense, it's, the Fed's pretty split, obviously, among the hawks and doves, but really it came down to, November, December, when it came to a question of the taper. And Powell almost seemed to outsource that decision to the non-farm payrolls number that we just saw. And so there's a lot of question now in the market. The market response to this has been very indeterminate, not really clear, because it was, as Matt covered here so cogently, this is a bad number on its face, but underneath it are a lot of different factors that that take away from some of the downbeat nature of it. Is this enough for the Fed to say, let's stay in wait and see mode in November? And it's really not clear. The market has been, focusing on how the Fed is still, the core of the committee is still in inflation is transitory mode. The communications have also been at pains to try to de-link the taper from rate hikes and saying, the decision to taper has nothing to do with the timing of rate hikes. That communication hasn't been particularly effective. We're seeing futures markets dragging forward that first rate hike here. And so it'll be interesting. If the Fed says, nothing to see here, this was kind of a bad number, but we're still on track for a November, I think that is the kind of risk of undermining some of their sanguine views on inflation. The market will sort of sniff out the fact that, well, these guys are in a pretty big hurry. They don't even want to wait until December. They must be more worried about inflation than they're letting on.
We don't have we don't have an FOMC meeting until first week of November too. So we're a month away. So I don't know how we're going to. I don't know how they signal any change, even if they wanted to change between now and then. I think we're kind of stuck with their most recent messaging. I don't think we have Humphrey Hawkins' testimony or anything between this month to sort of gauge. Maybe we'll hear from people like Clarida. And I don't know if Powell has any speeches or anything that might do some signaling, or Lael Brainerd, but it's you would love to see them get together a week or two after this number and give a little signaling. So I think we're kind of stuck on this path right now with a lot of open speculation.
Or maybe they don't want to signal. Maybe they want to preserve some strategic ambiguity. Who knows?
Yeah, the Fed has certainly been almost tunnel vision with regards to the taper. Their formulation is substantial further progress toward the inflation and employment goals, and pretty much unanimously they've said we've achieved that on the inflation side, maybe overachieved on the inflation side.
I mean, it's worth pointing out. I didn't go through kind of like. This is obviously like focus on the BLS report itself, but at the same time, there's the Times has a story today on the robust market for college graduates, and you simultaneously to this report have at least a lot of anecdotal evidence, pretty much across industry, of people looking for hires, right? Yeah. And it's not necessarily. There's a lot that can impede hiring in terms of skill match and other things, but willingness to work. And as Tony said, balance sheet and all the rest of the stuff is a factor. So, we've talked about this before, but the job market is a matching market. It's not, mentally, I think a lot of people think about it as a job created and there's someone who wants it. Normally that's the way it works, but not necessarily. And so, part of, I think, Fed calculation and some of this has to be are the jobs there for the taking, or because if the jobs are created to be taken, that is what they can do. Encouraging people to take those jobs is a slightly different exercise. So even if the job market isn't where they necessarily want it to be, they may actually be at the end of what they can do to get it to where they want it to be. And that kind of implies a different calculus as they weigh whatever tension there may be between inflation and employment.
Yeah, or they just may focus on the household number and say, look, at the end of the day, there are only so many workers we're going to be able to draw back in, and the rate is the rate. And it's an accurate rate, and we're seeing, there is, if you do dive into the household survey, which I just did a little bit, didn't do as much as I would, if we have a little more time, dive deeper in. There is a lot of underlying strength in the household survey.
Yes.
and like, I mean, the private sector job creation in there is pretty good, and so, so the Fed could just say, yeah, like the, payrolls is noisy. We're going to focus more on the household survey, and that's keeping us, sufficiently on our path. And so we're not trimming the sails at all. We're going to, keep going in the same direction.
They've certainly left themselves open to that. They have the doves in the committee have signaled that they're pretty close to feeling comfortable that substantial further progress on the labor market side is achieved, but waiting for more information. This is that more information, and they haven't necessarily focused on the household survey or one particular element of the and so this is going to be something of a Rorschach test, right? It's like you can see a lot of different things in this number. And if the Fed decides that they see, if the dovish wing of the Fed decides that they see enough positive information to tip the scales toward a November announcement of QE, when they could, arguably wait until December. The December meeting gives them 2 more non-farm payroll numbers, gives them those pivotal months of October and November to get a handle on things. Also, sort of in that time frame, there's likely to be a decision on personnel, very key personnel announcements for the leadership of the Fed. And so if in fact the dovish wing of the party sort of breaks for a November taper, I think the markets are going to read in like a ton of subtexts onto that, and some of those subtexts will be the personnel aspects, and some of them will be questions about where is the Fed's head really at when it comes to inflation, and where are they, are they concerned about the effects of keeping QE on too long? Are they really getting cold feet about this policy, and they aren't able to wait even another month into December? So they've sort of made this bed for themselves, obviously, by this formulation and focusing so clearly. It's created this tunnel vision, and they can't focus on other stuff like, oh, the retail sales were here and that sort of stuff. The Fed usually looks a lot more holistically at the economy, but because of the formulation that they had, substantial further progress toward those 2 very specific goals and everything else kind of excluded, they're sort of stuck with this number.
Sure seems like it. I think that's right. It seems like that's the way the market's reading it right now too. It looks like we're kind of flat as we kick off trading today.
Yeah, it's bounced around a little bit. The sense is probably that, all else being equal, the Fed will probably, put off. Well, if the Fed, there's certainly the argument that if the Fed puts off the taper announcement from November to December, that's an academic distinction. And we think actually that it has the potential to do a lot more signaling than that. For the reasons we just talked about, but yeah, there was expectation that this would be a real volatility inducing number, but that's not what we're seeing.
All right. Anything else in the jobs report that we should dive into? Does that pretty much cover it? It seems like that's it, right?
Yes, predict what next month's going to be.
Predict it, yeah.
I think that there's a lot of in everything that you've all said about the employment number. I think there's just a lot of course there's a lot of noise, but I think there's a lot of hope in a rebound. It's if you just looked at the public health numbers, if you just looked at COVID cases and said, what is economic data going to do over the later summer and early fall while Delta is giant, you'd probably guess, well, it's not going to it's going to be a little bit messy. It's going to be a little bit sloppy. And if you said, what happens once the Delta wave tapers and kind of ebbs off a little bit, you would probably say things are going to get a lot better.
Yeah, it's worth pointing out too. I didn't mention it, but but earnings continue to trend up. Those numbers, because of composition effects, have been pretty messy, but they've been kind of trending up for months, and that's good. That would indicate that employers are doing their best to attract people to the workforce, and that workers are making more money, and everybody likes that.
Definitely. Well, hey, it might be a good time over the next few weeks or so to get John Dick back in here, and especially on some of the points that Matt mentioned about when people are planning to buy and things like that. I'd love to hear.
No, that would be great, especially with higher energy costs. It would be interesting because it's kind of fascinating. Higher gas prices now actually is slightly positive to GDP because of how much oil we produced, where it used to be massively negative because it crimped into the consumer. So that would be interesting to see, how the consumer's thinking with, gas prices at the pump aren't crazy, but it's certainly a lot higher than it was 6 months ago.
Yeah, definitely. Hey, why don't we take a break right now and come back? And I'd love to come back and talk about energy and what's going on, not just here, but globally on energy, because it is absolutely a story of the week. You're listening to the Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, back on the Macrocast. Brendan, you started talking about what is going on with in energy markets right now, not just here in the United States but globally. There was a really great point. We tend to forget sometimes that we're if not one of the world's largest producers of energy. If you add up all forms, I think we probably are the largest energy producer in the world. So thinking about it, whether it's going to hurt GDP or add to GDP when prices rise is always it's a fun question, a different question from when I was learning macroeconomics in the 80s, the way we think about it. But what is, can you tee up like just where things are right now with energy prices and what do we think is happening?
Right, exactly. So in the U.S., it's kind of maybe the third, fourth most interesting story going on. But gas prices have gone up, but especially natural gas prices gone up. We produce a lot of those, so we're fine, especially going into the winter. But Europe does not produce it, except for Russia. So there's been a lot of fear going into the winter that there's going to be massive shortages, especially of natural gas. So gas prices have gone up, and natural gas prices spiked. Earlier in the week, I think on Wednesday, they were up as much as 60%. But then Vladimir Putin actually came out and said that, don't worry, we'll flood the market. We'll be okay. So they have come down in the last couple of days. I think he was worried that natural gas prices have gone up enough that people would switch to gas, and which is obviously bad for Russia because they produce the natural gas. But there's still a lot of fears that Europe's going to have, and not just Europe, but especially Europe, but also Asia, which doesn't produce it, that the winter is going to be hard for them, and we might have a energy shortage going into the winter months.
One of the things that's we see it with crude prices. Is that we have to remember that crude is it's a global market, right? So, so if global demand increases, that increases the price of crude oil here in the United States, even for the barrels that we produce here in the United States, because if you're a producer, you need to make a decision as to whether you sell it here or you sell it somewhere else, and if the price is higher somewhere else, that's where you ship it. And are we seeing that with LNG? I mean, so for example, there's acute LNG shortages in Europe, and you're right, we do produce, as all the natural gas that we need in the United States, but it does have a price impact in the United States because, I mean, to us, 10 years ago, we didn't have the infrastructure to export LNG in the way we do today. Now, LNG is a much more mature global market. And so therefore, the global price of LNG should impact domestic prices here more than we might have seen in the past. Are you seeing that?
They're at multi-year highs. Yep. It's definitely had some spillover effect, not as acute, not as high as the super spikes in the early 2000s that we saw in natural gas, but these are relatively high prices, and certainly for the US. And the spillover into, as you said, Tony, everything's connected in energy prices. If you can't get energy someplace, you try to get it in other places. And certainly the spillover into crude oil has been notable. We had an OPEC meeting earlier this week that resulted in no joy for the global energy markets. It was a steady as she goes approach from OPEC, talking about how they're concerned about demand tailing off at the end of the year. Right? What? Demand tailing off at the end of the year. So they kept their scheduled roll off of COVID era supply curbs at 400,000 barrels a month. There was a lot of talk that they would up that to 500, or even some estimates as much as 800, after a relative, quite a high level delegation from the U.S. The National Security Advisor, Jake Sullivan, went over and met with the Crown Prince. Surely the White House told everyone that oil was on that agenda. Surely they had very sharp exchanges on that. And
I feel like that was a very underreported story. It's kind of a big deal.
And obviously, Russia was part of it. It's not just the Saudis, and there are a lot of moving parts in OPEC, no question about it. But that's a straight up affront to the global to basically some global major powers. It's not just the U.S. It's, Brussels to Beijing's grappling with this. Would have been a whole lot nicer to have a little team play from OPEC, and instead, crude oil prices are above. If you're looking at Brent, the international benchmark, that's above 80. That's like $82, $83 a barrel, and WTI, the U.S. benchmark, is knocking on the door of 80. These are not like super spike prices, but these are uncomfortably high. And it's not where if you're the Biden administration, you want to see energy prices. If you're really any administration,
uncomfortably high. But although if you're producing in tar sands, you like that price, right?
Yeah, and so this is where the U.S. tar sands, shale oil supply crew, the wildcatters, the expectation that the drill baby drill crowd rides to the rescue here with some supply. It does take time, but the supply response in the U.S. shale patch is so quick. So that's one to watch. The Saudi oil minister has said the shale patch is reformed. They are no longer, they've got supply discipline in a way that they never had in the past, but that is a testable proposition. And, $80 a barrel will test that proposition.
That will test it. Absolutely. Yeah. But it is. There's also the change in the in the energy mix as well, in terms of I think Europe is somewhere in the range of maybe 30% of its energy needs is being met by renewables right now, which is pretty dramatic. I mean, we in some ways, and that has largely come at the expense of coal. We've seen gas come in and fill some of that hole. It's the same in the United States. I mean, not quite as dramatic on the renewable side, much more use of natural gas, but with coal coming off, there is how much of
yeah. So actually, that's interesting because in this infrastructure bill that hopefully gets passed so that we can pass the debt limit in December, that's a big debate going on, whether they put mandates on how much renewable fuels we're going to use in the future. So this bill could have sweeping consequences on our energy infrastructure going forward, for better or worse. Because if you demand renewable energy that we're not able to meet the demands, that you could have a disaster.
We're seeing that in China. That's very prominent now. The Chinese trying to reach the emission goals and the climate goals that they've set for themselves. They have a lot of coal-fired power plants. Those power plants sell at fixed prices. We saw the government begin to try to liberalize some of those prices as those plants went dark, given the spike in coal prices and the fixed, and so that wasn't profitable to produce energy, so they didn't produce it, and that's in a command economy.
Well, I think overnight, and I don't know if you saw this, John, but I didn't get a chance to look at it deeply, but did see a scroll on this where apparently China, the Chinese has in fact commanded coal companies to step up production.
Exactly. Yeah,
now.
and they've liberalized to some extent. They've given the power producers some leeway on electricity pricing, and they've basically, as you said, they're motivating coal supply. This is now a national priority. The government has mandated that all power producers secure all necessary supplies. It's a scramble for supplies, and that's feeding down into clearly across the energy space. But then the knock-on effects are these dominoes falling back in the supply chain. If you aren't producing power, the factories are closing down or having brownouts and that sort of stuff, and you end up with reverberations around the globe.
Yeah, and the irony of that is that as we see these movements, I mean, this week, you see things that look something like panic buying, right? And panic buying and hoarding as much as you can hoard going into the winter, because you don't know what that market's going to look like, and you don't know whether you're going to be able to get things around to you when you need it this winter, and that's in China and Europe and elsewhere. So it's definitely a super important sector to watch right now, and we'll keep paying attention to it. We had some other news. I'm going to come back after the break, and we had some news on all of the U.S. fiscal measures that we've got on. Brendan mentioned infrastructure bill, but infrastructure, debt ceiling, and the budget, and the Build Back Better plan. When we come back after the break and just take a quick look on where things stand with U.S. fiscal. You're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter at marketspolicy.
All right, we're back on the Macrocast. So, guys, we had we had a temporary reprieve on the debt ceiling, which was hurtling towards us like an asteroid. And Mitch McConnell came with a plan to put off, to raise the debt ceiling to get us into the first week of December, and that seemed to take and that passed, in both houses. So we're going to be in good place with the debt ceiling. I'm sorry. Passed in the Senate. We're going to come back and take care of it in the House, and I think we'll be in good shape there. It took some of the tension out of the markets. Maybe took some tension out of DC for a little while until Chuck Schumer gave a floor speech that infuriated everybody, both Republicans and Democrats, and just to make sure that the pot keeps boiling. But it does give them some time, as we're running against this clock, which now, in the case of the infrastructure bill, it's supposed to run to the end of December, the Halloween infrastructure bill, or what might be Day of the Dead. We'll see. And then more time on Build Back Better to see if Democrats can come to agreement on where they want to be on the number and composition there. We'll see whether they make good use of this time. I'll tell you my sense on this is we're going to get the debt ceiling done. I've been a strong believer that we're going to get both bills done. I am leaning much towards the prospect that they're going to get infrastructure done and not the Build Back Better plan, and because I don't see how they can bridge this gap right now.
I'll tell you one factor to keep an eye on that the political brains are watching, but I don't think the markets are quite as attuned to, is that in an off-cycle year like this, there's two races that happen, which is Virginia and New Jersey. And the Virginia race for governor is being watched very closely by everyone for an indicator of okay, does Trump backlash still have legs, which is the Terry McAuliffe thesis of the race, or does kind of Democratic overreach cause whiplash in the suburbs with schools and trillion dollar here, trillion dollar there kind of thing.
Yeah.
And in an environment where in Congress you have a 50 plus tiebreaker majority in the Senate, and you have 3 seats in the House, is that if Terry McAuliffe goes down, and that election is less than a month away now.
Yep.
You may see some serious recalculation among the moderates in the Democratic Party that result in exactly what you're talking about, Tony, that the Build Back Better plan is just kind of like, hey, you gave it your best shot, but we're not there. And people start to, the closer we get to the end of the year, the more people start thinking about reelection. And it doesn't take a lot of people to say, hey, I'm going to hunker down in my own race and love to help you out, but I just can't. And it just doesn't take a lot. And I think that is a timeline that, we keep blowing through deadlines, and it's, they're artificial and whatever, but that election isn't getting delayed. And when that happens, the political side is going to look at that with fresh eyes. And I don't see a path where Build Back Better passes before that election.
Yeah, because we get a little too caught up in talking about numbers, maybe we can agree to 2 trillion, but the difference between 1.5 and 2 trillion and 3.5 trillion is very progressive programs. So it's really not the number. It's actually what makes up that number that the battle is going over. I think it's more important to talk about, what that bill is rather than how big that bill is.
There's Matt, I think there's a story to be written by one of our favorite, reporters out there on how those off-year elections, especially Virginia in particular, and occasionally some special elections, on how they have impacted policy going forward. I think it would be a terrific story for Jonathan Martin or one of our other really brilliant writers to work on. There is, I think this one in particular, I think you're right. There'll be some very interesting signaling for, expectations for 2022 that come out of that race in particular.
So, Tony, you think that we pass the bipartisan infrastructure bill and tack on the debt ceiling to that?
Well, yeah, I mean, look, I think that's the attempt. The other attempt, the debt ceiling will be raised. They're not going to not do the debt. I know we've said this 1,000 times, but that it would be truly disastrous. Some people don't understand why it would be so disastrous to raise to fail to have the default, to fail to raise the debt ceiling. And we went through this 8 years ago or 10 years ago with S&P downgrading the U.S. government just over dysfunction over raising the debt ceiling. The thing to understand is that the full faith and credit of the United States that debts will always be paid gives us a pricing premium on our debt. Always, everywhere. It establishes the baseline for Treasury securities, the 10-year, which we benchmark. We use as a benchmark for all other forms of credit. If we are going to, in fact, introduce the possibility that the United States could default on its debt, which you would have to factor in, you elevate borrowing costs from now and forever, and that's so it is the worst thing you could possibly do on the dumbest, process kind of policy. I mean, it's just really, it's a stupid issue, but with the worst consequences. And so that's going to get done. It'll probably get done in a reconciliation bill. It'll either be a reconciliation bill that does reconcile and have a lot of the Build Back Better stuff in it, or it doesn't. Now, I could see them doing a Build Back Better that is a number that is much closer to Joe Manchin's number than the Progressive Caucus number, right? So a number that begins with a 1, and he and Sinema Manchin win. And they get a number that's much more palatable for them and the other moderates, and you put debt ceiling in that, and the progressives are upset and angry. But, if they've learned anything, is that, a lot of these are, relatively new programs. You get them started and you come back again and you add to them. They're going to have another reconciliation bill in 6 months. So, what do they, come back and fight another day on it if they want to. And I think they'll come to that realization. But there's always this thing in Washington where you can give in. You just cannot give in without a fight. You have to fight to the end so that you can then show your constituents that you did all you could before you bailed. The political cost is bailing too early. You need to bail at the very end, before when you have in the Bond movies, when the clock is ticking down. You don't stop it at 9, right? You got to stop it at 2 or 1.
No, I think you made 2 points there. The 2 rules of DC: 1, you got to put up a fight, but 2, once something's on the books, it never comes off.
Right.
Just get it on the books. It doesn't matter how big it is, because you can add to it later.
And the social programs, that anything that falls off the back of the truck on this reconciliation bill is going to be something that they run on. We've talked about this in previous shows. They'll run on that for the midterms. And that American Families Plan, we haven't even talked about that. That's another multi-trillion, strictly social policy plan. And it's still sitting out there. Anything that isn't that gets Sinema out of this bill is going to get tacked onto that one and will be a national, or at least part of a national platform for a lot of the Democratic candidates.
All right, guys. Another jobs day in the books.
Always a fun day.
Yeah. I told you it was fun.
Yeah.
I said it was fun too. Have an awesome weekend. We'll catch you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.